Hey, welcome back to Living in Minnesota. My name is Joe Carmack, and it's time for your Twin Cities real estate market update. This is for July 2024, but it's actually my second favorite market update of the year because in this episode, I'm going to recap for you what's happened over the last 1 month, the last 6 months, and the last 12 months so you know exactly what to expect if you're thinking about making a move. Why don't we start you off with month supply of inventory? This is that relationship. Are we in a buyer's market or are we a seller's market? And the lower we are in these graphs, the more of a seller's market is, the higher, the more of a balanced or buyer's market we are. So that's what you're looking at right here. And I'm going to show you primarily just the rolling 12-month averages. If you followed me, I go much deeper into the month-to-month changes. We're not going to do that for the most part today. So everything you're looking at here is the rolling average over the last 12 months. And there's really no big surprises, so I'm not going to spend a lot of time on here. But we did say at 2.2 for last month. It's been going up since basically January of 2022. Now, if you're feeling like there's a big change in the market, there is, as I'm going to show you in a number of slides, but it really hasn't happened anytime recently. This has just been a gradual change that we've been seeing over the last couple, 2, 3, 4 years since we really bottomed out. If I zoom out from this picture here, this is that long term that you're looking at. So that was this little valley right here. So we love to see the direction that things are trending. If you had heard of horror stories of it being an extreme seller's market, we are pulling out of that. Market's very much not crashing, sky's not falling, prices aren't dropping dramatically. We'll go over prices and rates at the end here. But overall, we're liking to see this continued trend, and it's moving in the right direction at a relatively slow pace. That is, of course, going to affect our days on market. And what you're looking at right here is the days on market for the last 5 years on the rolling 12-month average. We did see a weird little drop from the 19 days we had started with down to 18. But as I put up the numbers here for the last few months, or the last year or so rather, you can see we're actually the exact same place now that we were 1 year ago. So there's no significant changes that we've seen in the last year. However, there is a pretty dramatic difference in the days on market. That just happened from the previous year. So in about 18 months, we went from 11 days on market to 19, which is a pretty dramatic shift. That's 50% increase almost, but we haven't seen that change continue on. If we pull out and look at the long range, however, you can see where we've been and so where we are currently. Now, we do have to, of course, take this as another extreme like we have been in right now. So that was from the previous big boom and bust and recession that we saw, the Great Recession. And then here is the opposite extreme. So we are expecting to get somewhere back into the middle. And I did want to point out with our days on market, if you're looking at homes on the market right now, you're probably seeing there's quite a few that are going to be, 30, 40, 50, 60 days on market. It'll depend on the price point. Some clients I have looking in maybe the 400 range, they're only going to see 2, 3, 4 weeks on market versus some that are in the higher range. Over $1 million, we're seeing those that are certainly going to have higher days on market. Now, this is the median. The average days on market is actually around 40. And in my experience, working in this day-to-day, most of the time we're seeing homes that are around that number. And so what does that mean for a client? I mean, ultimately, you're watching this because you're wanting to understand how are these numbers going to affect your home buying or selling experience. And my thoughts on it are that everything is moving a little bit slower. It doesn't mean that the buyer is going to be able to negotiate an insane deal just because it has been on the market for a few weeks. And when you're a seller, it definitely means you just can't overprice that home. You've got to be a little more conservative simply because things are moving slower. We're really not seeing a lot of multiple offers in today's day. They definitely happen, but it might be a 1 or 2 multiple offer situation versus 10 that we had seen a couple years ago. Now, that days on market number is definitely affected by the number of new listings. Let me clear off my screen there. So this is the number of new listings, and this is the rolling 12-month average. So in a given 12-month period, we'll see about 63,000 homes in the Twin Cities get listed for sale. Now, this one was very surprising to me at first. You can see we did take a dip there. So I had to do a little more deep diving to figure out why we would have gone down in the number of new listings, which is not on trend. As you've seen, we've been increasing the last several months. So a couple things that I noticed. First of all, that's actually only about 315 homes less than we saw last month. So it even though it looks pretty significant, when you're at 63,000, that's not a huge drop. And then the other thing is this is a rolling 12-month average. And so I realized really, if we go back 12 months from last month, it would have been somewhere in here. I forget exactly where it was at. Maybe it was right in here, was that 12-month rolling average. So the numbers you're seeing are taking a 12-month average from those 2 points from the current month and then going back 12, obviously. And so with those numbers, they actually have been coming down pretty significantly. And so then if we're looking from this current month, it dropped to basically like this. And so when you're cutting out this number of new listings in the 12-month average time period, That's really what's affected us. So I don't see any concerns for the number of new listings that are being put on currently. We're just being affected by how quickly those dropped from 2022 all the way down to 2023 timeframe. So with those being the number of new listings for sale, how's that affecting our homes that are actually for sale? And if you're confused with what you're looking at, the previous slide's 63,000 homes rolling average, but then a whole bunch of those will of course sell. And at the end of the month, how many are left over unsold on the market? So that's where we're coming up with 8,200 homes that are currently in the homes for sale rolling 12-month average inventory. And that number is going up. We really like to see this. It's the same thing, how it's been trending. But this is, of course, kind of supply and demand. If a bunch of sellers list their homes, buyers don't pick them up, then that's what's going to increase this number. And so that's sort of painting the picture for those that are thinking about buying. We're seeing a fairly consistent number of sellers listing their homes, but because of interest rates, buyers are pulling back a little bit. And so with that inverse, the number of homes that are still available is increasing just slightly. And then that's going to bring us to the most important things everybody really wants to know about. That's what are home prices doing. Now, if you saw my video last month, you know that I was pretty shocked to see that pretty significant increase in the number of new listings that we saw from April to May. Fortunately, we didn't see that again from May to June's number. We were up to $375. I think that was about $500 or $600 maybe in the median sale price that went up. So that's not a terribly significant number. That 2.9% that you're seeing, that's over the last 1 year. So if I roll in those numbers for you, you can see from January this year, we're up about 5,000. From 1 year ago, we're up about 10,000. And then from January 2023, we're still up about 10,000. So there hasn't been that significant of a difference, being at 2.9% for the last 12 months. And then with 2023 to 24's number, that was only about 1.2 that we saw in the calendar year of 23. Overall, this is a lot less appreciation than we have seen in years past. And I put together a little compound interest graph for you here. Now, this is if we just zoom out to that long-term view, and that orange dotted line is basically if I took 175s, I use just kind of a generic starting number, and then this orange line there is compounding at basically 4% appreciation every year, which is the long-term historic average is somewhere between 3 and 4%. So if we take that number starting at 175, we were actually just slightly above where that line would have been. You remember we were at 375. This is saying we should have been at 369. So how does that affect you? Well, if you were in the camp of those that were hoping for the sky to fall, hoping for things to drop, that was your opportunity right here. This is basically we just sat flat. There was no major changes in sale prices. We did dip a little bit for a while. Then home prices came up, that 1.2. And then we're up about 3%. So overall, we're getting back on track for where we should have been. And the number one thing that is affecting all of that is, of course, interest rates. And I finally have some good news on that one as well. So let's take the normal look at interest rates, and I'm going to pull it out to kind of a long-term view for you as well. 6.3 is what I pulled up for today, according to Mortgage News Daily. So that is fantastic news. It's the first time we've been under 7 for a little while. So we're very happy to see that. Rates are still fluctuating quite a bit. But if we start on that right-hand side here, you can see where things have gone over the last 30 days. And then this is the 1 year range here as well. And we're actually almost exactly where we started 1 year ago. So that's the good news. We obviously didn't like to see at all when rates were getting up above 8%. We were optimistic that they were going to stay and go low here. We didn't see that, of course. So the beginning and middle of this year, we saw rates spike back up. And in case you've had your head under a rock, we are still hypothetically expecting that these are going to keep going down. As we go into the presidential election, it's happened every year for the last 20 years, so we're hoping that that will still happen. We're all just very surprised, though, that it hasn't started yet. So how is that going to affect things as we go into the rest of the year? Well, certainly there's a lot of people in the camp that say when interest rates come down, prices are going to go up because people haven't been buying and selling as much as they would have wanted to. There's pent-up demand, and so once those rates come down, which are holding people out of the market, they'll then jump into the market, and then that demand could definitely increase prices. I have also heard other people that don't think it's going to, which is a curious idea. I don't know that I agree with it, but some have said when rates come down, prices will come down too. I don't see that all happening with our market currently, just where all the rest of the numbers are showing. And I always want to give people a little perspective on the long term. So if you will humor me for just a second, this is what we're looking at is the 5-year trends for where interest rates are. And I think a lot of people that are in the mindset of, I'm just going to wait until rates come down, or I'm just going to wait until prices come down. Nobody's projecting that prices are going to come down, really. However, this is what interest rates are. And I think it's fairly understandable because if your mindset is, I'm just going to wait until rates come back down to the threes. That would, if you're thinking in a 5-year plan, that would make sense, right? I don't want to buy at 7 if I might be able to get 3. But that's just a 5-year view. It's a really, really limited perspective. So then there's the other extreme, which is, all right, let's go all the way back and let's look at the entire 50-year history that Freddie Mac will give us. And then you're looking, I think, at another extreme, and this might paint a good picture, not because some agents would say, well, who cares because the long-term average is, well, at least rates aren't 18% or the long-term average is 10% or whatever they say. I think we need to recognize that this is an extreme. We're not going back to 15, 18% interest rates. But we also need to recognize that this is also another extreme. Okay, so if you average out this whole graph, what are we doing long-term historically? I don't think we're ever going back to even double digits, 15, 18%. I don't anticipate is ever going to happen again. But I also don't think that the other extreme is going to happen again either, and that we're going to get back to the 2 and 3% that people loved, but are going to be unrealistic for the future going forward. So where our number is going to go, I really have no idea. But I would argue that perhaps a more healthy perspective is going to look at about the 30-year graph. This is, I think, going to limit the major extremes of the highs and put in perspective the lows. And so if you're coming into this, perhaps 6% is going to be a better average trend line that we'd get back to. I would love to see 4s and 5s. But with where things are currently, I just don't think it's going to happen anytime soon. Even if you're looking at this, okay, so when were we below 6 before? Well, that was 2010, I believe. And then they took so long to go down. Obviously, things shot back up, but overall rates, they take a long time to shift back and forth. Almost always, outside of the spike that we've seen recently, they had to do that for inflation. And once things get under control, they're not going to be wanting to go back to the inflation numbers, and that's what interest rates were causing. So hopefully that helps you with your home buying and selling needs around the Twin Cities. My name's Joe Carmack. If we haven't met, I help a ton of people from YouTube. About 2/3 of my business actually is people exactly like you. So feel free to reach out. We'll see if we're a good fit to work together. You'll find all my contact information in the description down below, and I'll catch you next month.